So, everyone is constantly talking about the AI boom, right? Like,
Yeah.
it's everywhere.
Oh, absolutely. It's the only thing on anyone's radar lately.
Yeah, but nobody is really talking about the physical bottlenecks of it all. We're so focused on the software that we forget about the hardware. And today, we're doing a deep dive into a company that is right the center of that exact hardware problem.
Right. A company called Puetti Technologies.
Exactly. And I mean, our mission today is to sort of decode this wild paradox with them. Because on one hand, you've got this company securing a $500 million framework agreement for next gen AI.
Which is massive.
Huge. But then at the exact same time, their stock just absolutely plummets, like
Yeah.
29% in a single month.
Yeah, it's honestly staggering when you look at the divergence between their underlying tech and the current market sentiment.
It really is. So we've got a stack of financial filings, analyst projections, and sentiment reports to go through because it's just this brutal tug of war right now.
It really is.
Yeah.
I mean, on one hand, you have analysts like the folks at 24/7 Wall Street setting a price target of $22.23.
Wait, $22? That's what, over 100% upside?
Yeah, it implies a 117% upside from their recent levels. So the bulls are very optimistic.
But then there's the bear side.
Right, the bear side is heavy.
Yeah.
You have active lawsuits. You've got canceled Tier 1 purchase orders. And this highly publicized short report that's just dragging the valuation down.
It's just a classic case of market dislocation, right? Where all this corporate noise is completely drowning out the actual engineering progress.
Exactly. But to figure out if that upside is real or just, some pipe dream on a spreadsheet, we really have to look at the engineering first.
Yeah, because if the tech doesn't actually work, none of those financial metrics even matter.
Right. And POET's entire competitive moat rests on this thing they call their patented optical interposer platform.
Okay, let's unpack that. Why is this specific hardware suddenly a matter of survival for these huge hyperscalers building out AI clusters?
Well, it comes down to a physical barrier. In the semiconductor industry, they call it the copper cliff.
The copper cliff sounds ominous.
It kind of is, yeah.
Yeah.
So as these hyperscalers pack more and more advanced processors into their data centers to train frontier AI models, they are moving just unthinkable amounts of data.
Right.
And traditionally, that data travels over copper interconnects using electrical signal.
Okay, makes sense. We've used copper forever.
We have. But the problem is that electrons have mass.
Yeah.
And they have a charge. So when you push them through copper at these crazy high frequencies, they create a lot of resistance.
And resistance means heat.
Exactly. An immense amount of heat.
Which is why you hear all those stories about data centers spending billions on liquid cooling systems. They're basically just trying to stop the servers from melting, right?
Hit the nail on the head. But you can only cool copper so much before this signal degradation becomes a real issue.
Ah, so it literally just stops working effectively.
Right. At a certain speed, copper simply cannot carry the data without massive power loss and latency. And this is exactly where Poet's optical interposer comes into play.
Okay, so how does it bypass the copper problem?
Instead of forcing electrons through copper, they use optics. They convert those electrical signals into photons, light.
Oh, wow. Okay.
Yeah, because photons do not have mass. They don't have a charge. They don't create friction.
That's wild. So it just completely eliminates the heat issue.
Pretty much. And Poet's platform integrates all these optical components like the lasers, the modulators, the photodiodes directly onto a single silicon chip.
So no need for all those traditional bulky wire bonds.
Exactly.
Okay, let me try to ground this in a bit of an analogy for you. Think of these AI data centers like a rapidly growing city.
Okay, I like that.
If the AI processors are the skyscrapers, using traditional copper wiring is like forcing millions of cars down a single-lane highway.
Right, there's going to be a massive traffic jam.
Exactly. Eventually, they bump into each other, create tons of friction, and the whole city just grids to a halt under its own weight.
Overheating, basically.
Yeah. So Poet's optical interposer is essentially building these high-speed subterranean rail lines, or like stacking 100 invisible highways on top of each other using different colors of light.
That's a great way to look at it.
And the data travels at the speed of light simultaneously without ever touching or creating heat.
Right. And, that invisible highway is no longer just a luxury. It's becoming a structural requirement for the industry.
Because the AI models are just getting too big.
Exactly. We are shifting rapidly toward co-packaged optics, or CPO, where the optical engine sits in the exact same package as the processor.
Wow.
Yeah, analysts are projecting that the 800G transceiver market alone is going to reach $9.8 billion by 2032.
Billion with a B. That is huge.
It is. I mean, if you want your AI data center to function at 1.6 or 3.2 terabits per second, you simply cannot use copper. You have to use optics.
Okay, that sounds incredible in a pitch deck, right? But I've got to push back hard here on the reality of their execution.
Fair enough. Go for it.
If this tech is the absolute necessary foundation for the future of AI, why on earth did Pandalay post an $81.6 million net loss in 2025?
Yeah. The $80 million crater.
Exactly. And they achieved that massive loss while only generating like a microscopic $1.4 million in revenue.
Right. On the surface, it looks terrible.
I mean, for a company that supposedly holds the keys to this massive optical revolution, losing nearly $82 million looks like a failing business, not a revolutionary one.
Well, you really have to look at the structural pivot that was happening internally. 2025 was basically the absolute peak of their pre-commercialization phase.
Meaning they weren't actually selling anything yet.
Right. They were operating under a pure R&D model. And, in hardware R&D, you are burning capital to achieve yield and perfect the chip's lithography. You aren't selling finished products.
Okay, so it was an investment phase.
Exactly.
Yeah.
But if you look at the first quarter of 2026, that pivot to volume manufacturing is already visible.
Oh, really? What did the numbers look like?
Revenue ticked up to over $503,000.
Okay, $500,000.
Doesn't sound like a lot, but it's a massive proportional leap from the roughly $166,000 they reported in the same period the year prior.
Yeah, I mean, $500,000 in a quarter is a step in the right direction, sure, but it doesn't even come close to explaining an $82 million hole from the previous year.
I agree, it doesn't.
So strip away the accounting magic for me. What is the actual cash bleed happening here?
And that is the crucial distinction to make. The headline net loss of $81.6 million was massively distorted by non-cash accounting items.
Non-cash. So they didn't actually lose that money.
Right. Specifically, it was due to derivative warrant liabilities.
Okay, you're going to have to explain how that works because to the average observer, a loss is just a loss.
Yeah, it's a bit weird. So when an early-stage company raises capital, they often attach warrants to the shares.
Which are like options, right?
Exactly. They give investors the right to buy more stock at a set price later on. But under standard accounting rules, these warrants are often classified as liabilities on the balance sheet.
Okay, tracking so far.
Here is the catch, though. As the company's stock price goes up, the theoretical value of those warrants also goes up.
Oh, I see where this is going.
Yeah. The company actually has to report that increase in the warrants value as a loss on their income statement.
Wait, really? Even though not a single dollar actually left their bank account?
Yes. It is purely a paper calculation driven by the Black-Scholes pricing model.
So because their stock was rallying on all this AI momentum in 2025, they were essentially punished on paper. They had to book massive losses just to satisfy these accounting rules.
Precisely. And we actually see the reverse effect happening in their transition into 2026.
How so?
Well, in the fourth quarter of 2025, they reported a net loss of $42.7 million. But by the first quarter of 2026, that net loss shrank to $12.3 million.
That's a huge drop. Let me guess, paper accounting again.
You got it. It wasn't just them, turning off the lights in the office to save money. The improvement was largely driven by a $15.4 million non-cash gain.
Because the stock price dropped.
Exactly. It was a fair value adjustment of those exact same derivative warrant liabilities.
That is just wild.
So when you strip away all that volatile paper accounting, their actual net cash used in operating activities in Q1 2026 was just $8.8 million.
Okay. An $8.8 million quarterly burn rate is a completely different universe than an $80 million annual headline loss.
It really is.
So the core operational deterioration wasn't nearly as bad as the surface numbers suggested, but that brings us to the real crisis.
Right, the June plunge.
Yeah. If the technology is working and the actual cash burn is manageable, why did the stock just suffer a brutal 29% monthly decline in June? We're seeing what looks like a complete collapse in investor confidence.
And that collapse is almost entirely driven by legal, tax, and PR headwinds that all culminated at the exact same time.
The perfect storm.
Truly. First, the company was hit with class action lawsuits regarding alleged misstatements about their tax status.
Ah, yes, the whole PFIC thing.
Exactly. Their designation as a PFIC or passive foreign investment company.
So for anyone who hasn't waded into the absolute joy that is international tax law, a PFIC designation is essentially a giant trap for U.S.
It's a
investors.
very expensive trap.
Right.
Yeah.
Basically, if a foreign company holds too much cash or passive income compared to its active operating income, the IRS slaps U.S. shareholders with highly punitive tax rates.
Really complex reporting requirements, yeah.
It essentially makes the stock radioactive to domestic retail and institutional buyers.
It absolutely does. And the allegation in these lawsuits is that management misstated or failed to adequately warn investors about this PFIC status.
Which triggered the class actions.
Right. But it didn't stop there. Simultaneously, allegations surfaced regarding a breach of a non-disclosure agreement with a company called Celestial AI.
And an NDA breach in the semiconductor hardware space. That isn't just a slap on the wrist.
No, it's a huge red flag.
Intellectual property contamination is basically a death sentence in this industry. And this specific breach directly led to tangible fallout, didn't it?
It did. Marvell, which is a massive Tier 1 player, completely canceled their purchase orders with POE.
Ouch. That hurts.
The Marvell cancellation was basically blood in the water, and that event triggered a massive short report published by Wolfpack Research.
Of course it did. The short sellers always circle when there's blood.
Exactly. They capitalized on the narrative of the NDA breach and the tax lawsuits, and they aggressively pushed this thesis that the company was just fundamentally broken.
So you combine canceled Tier 1 orders, class action lawsuits, and a targeted short campaign.
Heavy institutional repositioning is just inevitable at that point. Capital flees uncertainty.
It really does. I mean, put yourself in the shoes of a retail investor holding the stock for a second.
It's got to be terrifying.
You rode a massive triple-digit rally earlier in the year because you understood the whole invisible light highway thesis, right?
Yeah, you believed in the tech.
And then over a single month, you watched 29% of your value just vaporize. And the crazy part is the optical technology didn't fail.
Right. The photonics physics didn't break.
No, the stock was crushed entirely by corporate governance missteps, tax technicalities, and lost contracts. It's just this brutal reminder that in early-stage tech investing, being right about the engineering doesn't protect you from the corporate mechanics.
It really doesn't. And what's fascinating is that analysts covering the stock are interpreting this 29% crash as a massive sentiment dislocation.
What do you mean by that?
Well, the stock being pulled down near that $10.23 mark mostly reflects the psychological overhang of the legal drama. It doesn't reflect a fundamental deterioration of the optical interposer platform itself.
So the tech is still fine?
Better than fine. The hardware development actually continued accelerating while the stock was crashing.
But development requires massive amounts of capital. And with Marvell walking away and short sellers aggressively circling, how on earth does POIT survive this transition?
It takes a lot of money to move from a lab to a factory.
Exactly. Building a semiconductor or photonics fabrication line requires an unbelievable amount of cash up front.
Does this whole legal and PR crisis threaten their actual runway? Like, are they going to run out of money before the factory is even built?
You'd think so, but if you look at their balance sheet, they've built a financial fortress specifically designed to weather this exact kind of storm.
Really? A fortress? Yeah. POIT has aggressively de-risked its capital position. So we established earlier that their operating cash burn was roughly $8.8 million in the first quarter, right?
Yeah, the real cash burn, not the paper loss.
Right. Well, right now, following a recently closed $400 million registered direct offering, they are sitting on roughly $430 million in cash.
Wait, hold on. A company their size managed to bank $430 million while under attack from short sellers and class action lawyers.
It's pretty wild. Over the last 12 months, they have raised a staggering $830 million in equity capital.
That is an insane amount of money for a company in this position.
And they have the potential to access an additional $661 million through future warrant exercises.
Wow.
Now, obviously, raising that much equity capital is dilutive to existing shareholders.
Sure, which is another reason the stock probably faced downward pressure.
Exactly. But in the hardware manufacturing space, you either dilute to build your factory or you die in the lab.
And they clearly chose to build the war chest.
They did. They have effectively eliminated any near-term going concern risk.
That much cash just changes the entire dynamic. It means they literally can't be starved out by the short sellers.
Nope. They have the runway.
And looking closely at the filings, it isn't just retail investors absorbing this dilution. highly sophisticated capital is aggressively buying the dip here.
Oh, you're talking about Jane Street.
Yes. Jane Street, one of the most prominent quantitative and institutional trading firms in the entire world, just disclosed a 6.8% passive stake in PUOT.
Yeah, that was a huge signal. When an institutional whale like Jane Street takes a nearly 7% stake right in the middle of a legal firestorm, it points to a very specific thesis.
That the drop was overdone.
Exactly.
Yeah.
It suggests their quantitative models view that 29% drop as an irrational overreaction to the legal news. They see it as an asymmetric entry point into the fundamental AI hardware cycle.
Because Jane Street isn't buying because they like the drama. They're buying because they see how management is structurally fixing the root causes of all that drama.
Right. They're looking at the
Like,
solution.
remember that disastrous PFIC tax issue that triggered the lawsuits in the first place?
Yeah, a radioactive trap.
On June 26th, management held a shareholder vote that successfully passed a resolution to re-domicile the company's headquarters to the United States.
Which is huge.
By becoming a U.S. domestic corporation, they structurally eliminate the PFIC tax risk moving forward. The trap is just gone.
Poof. Neutralized.
They systematically killed one of the biggest bear arguments against the stock in a single corporate move.
It was a very smart play, but, fixing the tax structure and having $430 million in the bank just ensures survival.
Right, and survival is not the same as growth.
Exactly. Capital on the balance sheet does not automatically equal revenue on the income statement. To justify their valuation, they have to replace those canceled Marvell orders. They have to prove that other Tier 1 customers actually want this technology in volume.
Which brings us to the commercial pipeline. And this is where the momentum seems to shift entirely back in their favor.
The Lumilens deal.
Yes. Just as the market was hyper-fixated on the Marvel cancellation, POAT announced the Lumilens supply agreement.
And this is not just a small exploratory trial run.
No, not at all. It begins with an initial $50 million purchase order.
Which is solid on its own.
But the framework of the deal is what really matters here. It is structurally designed to scale to over $500 million over a 5-year period.
Right. Securing a $500 million framework agreement at this stage is massive.
Yeah.
It establishes a formidable barrier to entry against competing silicon photonics firms.
It signals to the rest of the market that the tech is commercially validated at scale.
Exactly. But
Yeah.
the crazy part is, Lumilens is just one node in a much larger ecosystem they are trying to build.
Who else are they working with?
They are actively co-developing next-generation modules with companies like Lydian, Lessengers, and Quantum Computing Inc.
Okay, and we are talking about 1.6 terabit and 3.2 terabit per second modules now, right?
Yes, the really fast stuff.
Going back to our analogy from earlier, if the 800G modules are the invisible light highways, the 1.6 and 3.2 terabit modules are like upgrading those highways into, quantum slipstreams.
The data density is just staggering at that level.
And as these hyperscalers push the boundaries of frontier AI, those bandwidth demands are only going to scale exponentially.
Right. And POAT has publicly stated that they have more than 10 active customer engagements right now that are expected to exceed $100 million each in future annual revenue.
So the pipeline is heavily loaded.
Very heavily loaded.
Okay, so the pipeline is loaded, the cash is secured, and the whole tax issue is fixed. But in hardware, execution is literally everything.
It is the only thing that matters.
Right. Having an order for 1 million optical engines doesn't mean a thing if you can only physically manufacture 1,000 of them. So what is the actual timeline here? Like, what is the catalyst calendar we need to be watching over the next 6 to 12 months to see if this narrative actually plays out?
Well, the execution timeline is rigid, and it's unforgiving. Production of their 800G modules officially begins in the third quarter of 2026.
Okay. And where is this happening?
At their manufacturing facility in Malaysia. And to facilitate that ramp up, they are planning an initial $50 million capital equipment deployment just in the second half of 2026 alone.
Wow. $50 million in CapEx for half a year. What does that actually buy them on the factory floor?
It buys the highly specialized machinery required to scale photonics. We're talking about automated alignment equipment, really high precision lithography tools, and complex testing stations.
Because scaling hardware is notoriously brutal, right? Especially with yield rates.
It's a nightmare. If a laser or a photodiode on that interposer is misaligned by a single micron during the manufacturing process, the entire chip is dead.
A single micron.
Yeah, and their initial target for all of 2026 was to produce just 30,000 optical engines.
Okay.
But their new target is to scale capacity to 1 million units per month by the end of 2027.
Wait, hold on. Going from 30,000 units a year to 1 million units a month?
Yes.
That is an almost unfathomable logistical leap. I mean, that requires flawless cleanroom logistics, perfect supply chain synchronization, and a massive workforce expansion.
It really does. They are already onboarding about 50 new staff to scale their current workforce of 115.
So they're growing fast.
But that physical ramp-up is exactly where hardware companies usually live or die.
Which is why the ultimate catalyst here is that Q2 2026 earnings report, expected in August, right?
Absolutely. Everything hinges on management proving that the Malaysia production ramp is proceeding without delays or yield failures.
Because if they miss that...
If that Q3 production timeline slips, or if the initial batch of 800G modules suffers from high defect rates, investor confidence will completely crater, and it won't matter how much cash they have in the bank.
Right. The market has given them the capital. Now they have to prove they can actually bend the physics of light at a commercial scale.
That's the challenge.
Let's try to pull all of these threads together, because when you look at the fundamentals, you have a stock trading at a massive discount relative to the sector.
A very deep discount.
Yeah, the sources note PUAT's price-to-book ratio is roughly 4x, compared to the U.S. semiconductor industry average of 6.4x.
Right.
And it has been artificially weighed down by the whole PFIC tax drama, the NDA breach, and that short report.
But underneath all that,
Exactly. Beneath that bruised market sentiment, you have a structurally fixed U.S. domicile, a $430 million cash war chest, a massive quantitative fund taking a nearly 7% stake, and a validated $500 million commercial pipeline with Limelins.
it presents a highly asymmetric risk-reward profile for the next 12 to 24 months.
It really does.
I mean, the downside risk is entirely tied to their manufacturing execution in Malaysia. But the upside potential, that is tied to becoming the foundational interconnect layer for the entire global AI infrastructure.
And that's just a wild thing to think about. We spend so much time marveling at the software side of the artificial intelligence gold rush, you know?
Oh, absolutely. The algorithms, the parameter counts.
Right. The billions of parameters, the generative algorithms, chatbots that can somehow pass the bar exam. We treat it like it's this magic just happening in the cloud.
The cloud is just a physical building.
Exactly. It's a physical building filled with metal, silicon, and a ton of heat.
Yep.
So here's a final thought to leave you with. What happens to the global AI economy if the obscure hardware companies building this invisible plumbing actually fail?
It's a scary thought.
Is the ultimate ceiling of human artificial intelligence not going to be dictated by some genius software engineers in Silicon Valley, but by how fast and how perfectly an optical engine can be manufactured on an assembly line in Malaysia?
It really forces you to realize how fragile the foundation of all this exponential growth really is. The AI revolution isn't just code. It is bound by the brutal laws of physical engineering.
It absolutely is. And that's all for today. Thanks for joining us on this deep dive.